Okay, so we're back. And for those of you who just come into the session, I'm trying to record this session, so feel free to interact with me though, because my other ways of recording this video has somehow got into a trouble. So I am going to just use this class time and record the last third of these slides and videotape it and put it online. So bear with me, and I'll be a little bit funny at a time, but it's kind of hard to joke in front of a screen. So we just talked about top-down approach and the bottom-up approach, which kind of try to give you some idea of how you are going to choose your portfolio later on in the semester term project. Okay, so the markets, now we're going to talk about a competitive market kind of concept. So we just talked about in video number one, I asked you, do you really think that the risk and expected return are kind of having a trade-off? And the answer is yes, because if people are not really expecting any return, they are not going to take on any risk. Well, unless, well, even if you like gambling, you like the surge of adrenaline, you still were thinking, well, maybe I'm going to win big time this time. And that's why you're going to gamble. If you think, oh, definitely I'm going to lose, then probably you're not going to gamble anyway. So typically, high assets with higher expected returns will have higher risk. Okay, so on average, if you're talking about stocks, then the average annual return is about 12%. And well, the minimum can be really, really minimum, negative 46%, which means in that 1 year you lose half of your portfolio. Well, that I have to say, I was on average. You can get a lot worse than that. Okay, so then in the maximum in 1933, it's totally huge. You can gain easily another 50%, 55% on your portfolio. So and typically, stock portfolios lose money 1 of the 4 years on average. I'm not really saying that, oh, if you have lost money in the previous 3 years, you should be expecting to win big time in the fourth year, or vice versa. That's definitely not true. We're talking about an average of over 30 years. So that is something we're talking about the stock portfolio as a whole market average and also as an average over the time. On the other hand, if you're talking about bonds, then bonds typically have a much lower average rate of return. So how low is it? Typically under 6%. And it will not lose more than 13% of their value in any 1 year. So, I mean, in aggregate, in real life, if you invest everything in just one bond, you could as well lose everything, okay, in just one bond. I mean, that would be detrimental. But if that bond issuer just happened to default and decided not to pay you, then yeah, you lost everything. Okay. So how do we, that posed two critical questions to us. First of all, how do we measure the risk? And second of all, how does the diversification affect the risk? And these are the key questions for our class today, for our class in this semester. So the investments is going to deal with mainly, first of all, how do you measure the risk? Because everybody knows how to measure the return, right? So how do you accurately have a sense of how much risk you're taking? And then how are you going to use diversification to somehow mitigate the risk and still get the best return that you can? So these are the things that we focus in this class. Later on, if you're talking about overall how do you pick the portfolio to best suit your needs, then that's the portfolio management. That will be another course. So in efficient markets, these securities should typically be neither underpriced nor overpriced, but that is just fantasy. Let me tell you, it's the efficient market hypothesis is still under debate. When we're going to talk about the real thing later on in the semester, I'm going to teach you exactly what is the efficient market hypothesis, and it's whether it's true or not, it's up to your judgment. Okay, so will be one of your discussion topic. It will be neither. It's if you were in an efficient market, then it won't be underpriced, it won't be overpriced, it will be right on the money. Think about how hard it is because you don't even know how much is on the money. So is it really efficient? I don't know. There's many ways of testing it, and some say yes, some say no. And but if the market is close to efficient, at least we understand that some of the market, like the U.S. market, is going to be more efficient than some other markets, like Chinese stock markets. And what does that mean? Is that the U.S. stock market should really be reflecting more information compared to some other markets. Well, why do people really have a kuti on this? Why do people have to debate on is it efficient, is it not efficient? Well, it actually fundamentally affects your investment style. So if you believe the market is mostly efficient, then that means everything is already incorporated in the current price. What does that mean? It means the price is already perfect, right? So there is no underpricing and there's no buy and hold, and hopefully the price will correct itself, get into the correct price later on, and so that you can earn a higher return than normal. That will not happen because in an efficient market, the price will never be underpriced anyway. And on the other hand, it's not going to be overpriced too. So you are not going to be able to successfully short any of the stock. So if you really believe that the markets are efficient, then you'll be one of those guys who are going to manage it passively. What is passive management? Basically, you buy and hold the whole market. You buy and hold an index and do not intend to fiddle with it. Okay, so like what I do with my retirement fund, I put some money in it, I leave it there. Okay, I change the allocation between market asset classes, but I really don't do much in terms of actually trading. On the other hand, if you believe that when the markets are inefficient, that's when you want to spend most of the time a lot of effort trying to find that security that is underpriced. As exactly who is doing? Well, the most famous one, well, a couple of them, let's say Warren Buffett, right? He is the one always saying, oh, I'm going to buy the ones that are underpriced. And then I'm going to what? Hold it there. And sometimes if he has a block of stocks in it, and in his earlier years, actually, he did get into the management and try to do something really with the corporation, try to work with them, but not anymore, really. In recent years, he would just buy it and hold it, and hopefully the price will correct itself and get higher. So that is what we call the active management. So between the extreme of actively picking and trading every single security and the extreme of passively holding on to the same thing over the years, there are many kind of gray area. Okay, in terms of sometimes people talk about enhanced passive management, which means you mostly hold on to an index, but you are not holding on to, you're kind of selecting certain securities within that index and going to add a little bit extra onto that. That's one way to do it. You could be trying to avoid some other securities in some index. That's another way to do it. But if you want enhanced passive, you are going to be starting from an index. So that's the gist of it. We'll talk a lot more about these in detail, but right now we just kind of want to give you the main concept. Okay, so now we're convinced that the overall market kind of have a risk and return trade-off. Let's look at the players in the markets. So first of all, we have business firms, we have households, okay, you and I, okay, net savers with, well, I hope we are saving something. Then the government, okay, so the government can be borrowers or savers. They borrow through bonds and they save funds up and things like that. And there are financial intermediaries. These include banks, investment companies, insurance companies, pension funds, hedge funds. Okay, so we are going to, I'm sorry, let me take one tiny little break here.